Good morning. Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I'm Rose Marcello. I'm a client portfolio manager at IGAM, and my guest today is David McCulla, portfolio manager, fixed income. Alongside Alexandre Morin, David manages about 20 mandates within fixed income, among which IA's flagship core Canadian fixed income. Good morning and Happy New Year, David.
Morning, Rose, and Happy New Year to you.
Thank you for being here. Today, what I'd like to discuss with you is the performance of the bond market in 2024, which unfortunately once again fell short of money market performance, the influence of the new American administration on 2025's bond yields, and the investment opportunity in the credit sector. Does that work?
Yeah, let's jump into it.
Great. So maybe let's address bond returns that are slightly disappointing again. They're lagging money market. 2024 was also a particularly volatile year for bond yields. What conclusions can be drawn, and how are you now approaching the new year?
Well, when you look back at 2024, it certainly was another year of volatility in the bond market. And if you break it down sort of by quarters, we saw bond yields rose in the first quarter last year. Then they rallied quite nicely in the second and third quarter. And the 10-year Government of Canada bond, it approached 2.8% in mid-September last year. So when we looked at one-year performance at the end of September, it was quite a positive experience. If you look at the overall index, it returned almost 13%. So well surpassing the 5% the cash returned. What really dampened 2024 calendar year returns was the move higher in yields that we saw in the fourth quarter. So listeners may be wondering what caused this volatility, what caused this backup in rates. And most of that can be explained by the shifting expectations of what the market thought the Bank of Canada and the U.S. Federal Reserve were going to do last year. So if you look at throughout the second half of last year, the market thought the neutral rate of the U.S. Central Bank, its views on that, it ranged within 100 basis points. So that's a wide swing in expectations for an overnight rate. So if you look back in September, the market was pricing a neutral rate for the U.S. Federal Reserve at 2.75%. And then what happened over the following months, the market really became worried about the ongoing strength of the U.S. economy. You combine that with the Republican sweep, and then they started wondering, how is that going to limit how far the Fed or the U.S. Federal Reserve will be able to lower rates in the coming years? So what we saw was a swing in December. The market implied terminal rate assumption climbed to roughly 4%, and that was 100 basis points above what the U.S. Federal Reserve had suggested by means of the revised long-term dot plots, or the summary of economic projections, because it was only suggesting a terminal rate of 3%. When you step back, what history has really proven is what the market price is in very fluid and prone to sharp revisions. So I think the market tends to swing too far one way and then swing too far the other way. So we're approaching 2025 with a very open mind. We intend to continue to be very tactical in positioning of the bond portfolios and looking to add value for our clients. And we're also approaching 2025 with a sense of optimism for bond investors, given the attractive level of bond yields. And we'll look at the U.S. bond market. We closed last year with the yield on the U.S. 10-year U.S. bond at 4.57%, so call it 4.6%. This is a very encouraging starting point for the coming years in terms of coupon support. If you look at history, in the last 24 years, we've only ended the year that high twice, in 2002 and 2007. And when you look at the total return the following year, it was over 15% and close to 10% respectively. So well above what investors would earn sitting in cash. So we are optimistic for the year ahead when it comes to the bond market.
That's good to hear. I'd like to turn our attention to yield curves. Since let's say the pandemic era, let's say, we had been expecting yield curves to normalize. They indeed started to steepen pretty sharply, especially in the last quarter. How is the fixed income team's duration positioning within the portfolio being adjusted to consider this changing environment?
Well, yeah, so we've certainly seen a yield curve steepen, and that's quite normal in a central bank easing cycle. So looking at the easing cycle in Canada, the Bank of Canada has been very aggressive cutting rates since last June, taking the overnight rate lower by 175 basis points. So from 5% all the way down to 3.25%. And then if you look at the yield curve, and we'll look at the difference between Canada 2-year and 10-year yields, and look at that over the last 6 months, it's gone from being negative or inverted by 60 basis points. So the differential being negative 60 as far as basis points. And then it closed the year around positive 30 basis points. So it's steepened 90 basis points in the span of 6 months. Now, as far as our positioning, to the extent possible, we've positioned the portfolios to benefit from a steepening of the yield curve. So how do we do that? We've reduced our exposure to longer dated bonds and favoring shorter dated bonds. So moving from 30s into 10s or 10s into 5s. And as far as portfolio construction, we're not allowed to use leverage in our portfolios. So positioning for a curve steepening is more challenging when we want to be overweight duration, because when you're positioned for a steepening, you're selling longer dated bonds, you're buying shorter dated bonds. If you do that risk neutral or duration neutral, you're using up cash, and there's a limit to how much cash you have in the portfolio. And it's certainly much easier to do when we want to be underweight duration. So our curve positioning is at times a byproduct of a duration decision, certainly when we have a high conviction duration stance. What we expect for 2025 is the curve to steepen further. The market's currently pricing in just over 60 basis points of rate cuts in Canada for this year. And we believe the market's underpricing what the Bank of Canada will do this year. So, and as far as duration, we do expect bond market volatility to continue. And then as a result, we're going to continue to be quite tactical with our duration decisions throughout the year.
Good to hear. One last thing I'd like to mention, it's towards the end of the year, for example, we felt like on the geopolitical front, there was something happening everywhere, all with potential inflationary consequences. My question to you is, if this instability and inflation were to continue in 2025, how could these factors influence the construction of fixed income portfolios?
Yeah, let's face it, there's certainly a lot going around the world right now, from the continued Russian-Ukrainian war to the conflict in the Middle East between Israel and Hamas. And then on the political side, a lot of new leadership. We have it in the US, we'll likely have new leadership in Canada this year. I'd say looking at the election of President Trump, who will take office in a couple weeks, I think that election has increased the amount of uncertainty that's going to exist this year. And we've already seen the return of what we'll call the Trump tweets, and that's certainly caused some volatility and really raised more questions than answers. And when it comes to these tweets, which seem to be his favorite form of medium to get his message across, what we're going to have to continue to do, just like we saw in his first term of office, is really separate the noise from the actual policy changes. And I think front and center are Trump's tweets of tariff threats. And he's made tariff threats against 11 different countries so far. What we've seen this time around compared to his first term is a change where this time he's linking tariff threats to non-economic measures, such as border control. So we know what he's threatened, but we don't know yet what the actual tariffs are going to be, what they're going to look like, and also how other countries are going to respond to this. So I think bringing all this back to portfolio construction, what this highlights is the importance of a strong investment process and the need to be nimble and adjust portfolio positioning as we get greater clarity on the impacts of Trump policies and then other geopolitical events that we're facing this year.
It's certainly going to be an eventful year, just looking at the few tweets he shared already, or even like the crazy press conference we saw 2 days ago. Now I know a question about the credit market. So I know we've discussed this a couple of times. Credit spreads are currently at historically low levels. Do you think there's still value in the credit markets, or where maybe do you see the best relative opportunities in that environment?
Yeah, so credit spreads are quite tight, near historical tights. We've been here before, and we've managed to sort of stay there for a period of time before they widen. So right now, we still believe there is value in credit markets. We have maintained an overweight in spread product. That encompasses a modest overweight in municipal bonds, a modest overweight in provincial bonds, and then an overweight position in corporate bonds. And when you look at corporates, yeah, spreads are quite tight, but fundamentals remain quite strong. And then all-in yields are quite attractive and should continue to try buy and hold investors. Where we see some opportunities are in the higher yielding securities of strong investment grade issuers, and then some potential rising stars. And then looking across the yield curve from a term perspective, we continue to favor shorter dated corporates over longer dated corporates, as they just offer a more attractive risk reward profile.
Good. That sums it up for me today. Any last note you'd like to share, David?
Yeah, I'd just like to wish all our listeners a very happy new year and all the best for 2025. And I'd also like to thank our sales partners and their clients for putting their trust in us to manage their fixed income solutions.
Thank you so much for your time.
Thanks for having me, Rose.